Now, risk management, okay, and this is also a topic that gets a lot of people in trouble. When you start to talk about position sizing, really, really important topic. We probably should have covered this the entire day today. That's how important it is. When it comes to trading options, you have incredible leverage, but it also can get you into trouble very quickly if you're not properly using that risk. You do not want to trade just one contract or one spread on every trade. For those of you that are newer, you're saying, okay, I'm going to trade as small as I can. Let's just trade one contract on every single position. Problem there is trading one contract on Apple is not equal to trading one contract on Bank of America. They're very, very different price points. If you take that approach, the outcome of the Apple trade is going to dominate your P&L. It really doesn't matter what the trade on Bank of America does. Apple is going to be so much bigger that it's going to dominate the overall results. Whereas if you keep a set dollar amount, let's just say you risk $500 per trade. That might mean you're trading one contract on Apple, but maybe you're trading 3 or 4 contracts on Bank of America. By taking that approach, now they're equal. So now if you've got a winner and a loser, you can still potentially be up money. If you have a loser on Apple and a winner on Bank of America, you still have the potential to make money. If you're trading one contract on both of those trades, Bank of America wins, Apple loses, you're going to be down money. See how that makes a big difference? Now, I don't care what the dollar amount is. It could be $200, it could be $500, it could be $1,500. It does not matter to me. Everybody's going to be a little bit different because everybody has different account sizes. So we want that number. Ideally, you want that number to be in the 3 to 5% range of your account per trade. So you can do some simple math there. You know, if you've got the $10,000 account, we can do some simple math, right? Could keep your risk at a couple $100. When it comes to how to know what your maximum loss is on a trade, with the long calls and long puts, their max loss is whatever you pay for the option. Same goes for the debit spreads. The credit spreads, your max loss is going to be the difference between the strikes minus the credit you received when placing the trade. So if you're using a dollar-wide spread and you collect 40 cents, your maximum loss is 60 cents. It's just that dollar difference minus the 40 cents. That gives you the $60 of risk. That's your maximum loss on the trade. Now, you can take this a step further. If you actually want to use stops, use stop orders, you can use that when factoring in your position size. On long calls and long puts and debit spreads, we like to use a 50% stop. On a credit spread, I mentioned earlier, try to keep that stop in the 60 to 70% range, which is ideal. So you can actually use that when factoring position size. Here's what I'm talking about. The first option is you can assume a worst case scenario in that you're going to have 100% loss on every losing trade. If you buy an option for $2, you can factor your position size, assuming that if that trade goes against you, you're going to lose the entire $2. If you're using a 50% stop, you're actually going to get out earlier, but by using this option, you're actually building in an added layer of safety. You're going to respect that stop and take the partial loss, right? So you can use that, but if you're conservative like me, building in that added layer of safety, you're factoring your position size based on the assumption that you're going to take a full loss. So if you're risking $500 per trade, okay, you can position yourself. If you're buying a spread for $2.50, for example, you could trade 2 contracts or 2 spreads, because now your maximum loss is $250 per spread, whatever you pay for the position. We can put that on 2 times and have $500 of risk. That's the first option. That's my preferred option. That's the route that I recommend that you start with. Option number 2 is if you're going to use that 50% loss, you can use that as a way to determine your position size. So now, if you're using that same debit spread that you're buying for $2.50, you could put it on 4 times because you're using a 50% loss. Your maximum loss would be $125 per spread. You can put it on 5 times and still have that same $500 of risk. See how there's a difference there? So option number 2 is far more aggressive. It would be something that you could use if if you're trading a bigger account, or maybe you're only trading options with a fraction of your overall portfolio. I don't have a problem using the more aggressive route. If you've got a $5,000 account to start with, and that's all you have in your portfolio, option number one is far better to use. Take the more conservative route, use the lower risk. If I go back 5-6 years, I traded completely different back then than what I do now. Going back a number of years, I would focus on taking a couple of core positions, and I'd put on a couple of very big trades and hope for the best. It was just a completely different market back then. Now, because markets have changed so much, I find it far better to take a larger number of small trades. I know it's easier to put on 1 or 2 big positions and hope for the best. The problem is if you're wrong on those positions, you're in trouble much quicker. Whereas if you take a larger number of small positions, we can put on trades in some individual stocks, some ETFs, different sectors. Now you're able to layer in more diversification and give yourself more consistency. So keep that risk very, very small. Fight that urge to say, hey, we're in a very active market. This is a once in a lifetime market. Let's ramp up the risk. Let's shoot for the moon here. Don't get yourself into trouble. Okay, live to fight another day. Keep that risk small. The numbers will take care of themselves. As you start to grow that account, you can add your position size. You can add another contract, another spread, and still keep your risk at a very small level. That's going to set you up for long-term success. Most retail traders, they get into trouble because they trade too large. They trade too big a size, and it doesn't work out. They have a couple of large losses, and then they blame the market or they blame the system. And in reality, there's some mistakes there that are made by the individual that are causing them to miss out. And I say this because I went through all of this, guys. I mean, in the last 20 years, I've made every dumb mistake you can imagine. The key is to learn from those mistakes and set yourself up with rules that are going to guide you in every situation.